Welcome to Muscular Brain, Fat Wallet. In today's video, we're going to explore one of the most powerful tools in real estate investing, leverage. Leverage allows you to use other people's money to build wealth, scale your real estate portfolio, and maximize your returns. Whether you're a beginner or a seasoned investor, understanding how to properly use leverage is key to success in real estate. Part 1. What is leverage in real estate? 1.1 Definition of leverage. Leverage in real estate means using borrowed money to finance the purchase of a property. Instead of paying the full purchase price with your own money, you borrow a portion, usually from a bank or lender, and only put down a small percentage, called a down payment. This allows you to control a larger asset with less of your own capital. For example, if you purchase a $500,000 property with a 20% down payment, you're leveraging $400,000 from the bank. The idea is that you use this borrowed money to buy the property, rent it out, and let your tenants pay down the mortgage, all while benefiting from property appreciation. 1.2 The power of leverage. The beauty of leverage is that it amplifies your returns. If your $500,000 property appreciates by 10% over a year, the property's value increases by $50,000. But since you only invested $100,000 of your own money, the down payment, your return on investment, ROI, is actually 50%. That's the magic of leverage. Small investments can lead to large returns. Leverage allows investors to purchase more properties, scale their portfolios, and build wealth faster than they could if they were paying cash for properties. Part 2. The benefits of using leverage in real estate. 2.1 Maximizing ROI, return on investment. One of the main reasons real estate investors use leverage is to maximize ROI. Instead of using all your capital to buy one property, you can spread it across multiple properties by using leverage. This enables you to benefit from multiple income streams and property appreciation simultaneously. For example, if you have $200,000, you could purchase one $200,000 property in cash, or you could use leverage and buy 4 properties, each with a $50,000 down payment. If each property appreciates, your total returns could be significantly higher than if you had only invested in one property. 2.2 Creating passive income streams. When you leverage real estate, you can generate passive income through rental properties. By renting out properties, the rental income from tenants covers your mortgage payments, property taxes, and other expenses. Over time, the rental income grows, while your loan balance decreases, increasing your cash flow and net worth. 2.3 Building equity. Faster. As you make mortgage payments, you're building equity in your property. Equity is the difference between the property's value and the amount you owe on the mortgage. The more payments you make, the more equity you build, and over time, this equity becomes a significant portion of your wealth. By leveraging multiple properties, you can build equity in several properties simultaneously, accelerating your wealth-building process. 2.4 Leveraging appreciation. Real estate tends to appreciate over time, meaning its value increases. When you use leverage, you benefit from the appreciation of the full value of the property, even though you only invested a small portion of your own money. This allows you to capture large gains with a relatively small initial investment. For instance, if a $500,000 property appreciates to $600,000 over a few years, you've gained $100,000 in property value, even though you only put down $100,000 as the initial investment. This is how leverage can help you grow your wealth more rapidly. Part 3. The risks of using leverage in real estate. 3.1 Over-leveraging. A common pitfall. While leverage can significantly boost your returns, it also comes with risks. One of the biggest risks is over-leveraging, which occurs when you borrow too much money relative to your ability to repay. If your properties don't generate enough income to cover your mortgage payments, or if property values decline, you may struggle to meet your financial obligations. For example, during a market downturn, property values can drop, and rental demand may decrease. If you're over-leveraged, this could lead to negative cash flow, forcing you to sell properties at a loss or face foreclosure. 3.2 Interest rate fluctuations. Another risk is rising interest rates. When you take out a mortgage, especially an adjustable rate mortgage, ARM, your interest rate could increase over time, leading to higher monthly payments. If your rental income doesn't increase accordingly, this could eat into your profits or even cause financial strain. 3.3 Vacancy risk. Rental properties aren't always occupied, and vacancy periods can affect your cash flow. If you're relying on rental income to cover your mortgage payments, vacancies can create financial challenges. It's important to have a contingency plan and reserve funds to cover vacancies. Part 4. How to use leverage wisely to build wealth in real estate. 4.1 Start with a solid financial foundation. Before you begin using leverage in real estate, it's essential to have a solid financial foundation. This means having a good credit score, enough savings for a down payment, and reserve funds to cover unexpected expenses like repairs, vacancies, or rising interest rates. A strong financial position will make it easier to secure favorable loan terms and reduce your overall risk. 4.2 Choose the right type of loan. There are various types of loans available to real estate investors, and choosing the right one can impact your long-term success. Some common loan types include conventional mortgages. These are traditional loans offered by banks and mortgage lenders. They typically require a 20% down payment and offer fixed or adjustable interest rates. FHA loans. These government-backed loans are designed for first-time homebuyers and require lower down payments, as low as 3.5%. They can be a good option for new investors but come with additional fees. Portfolio loans. These loans are provided by private lenders and are typically used by investors with multiple properties. They often have more flexible terms but may come with higher interest rates. It's important to compare loan options and choose one that aligns with your investment strategy and risk tolerance. 4.3 Use leverage to scale your portfolio. Once you've successfully acquired 1 or 2 properties using leverage, you can begin scaling your real estate portfolio. By refinancing properties that have appreciated or by using the cash flow generated from existing properties, you can purchase additional properties without using much of your own capital. For example, after holding a property for several years, you can refinance it, pull out some of the equity, and use that money to make a down payment on a new property. This allows you to keep growing your portfolio while maintaining positive cash flow. 4.4 Monitor your loan-to-value, LTV, ratio. Your loan-to-value, LTV, ratio is the amount of your mortgage relative to the value of the property. It's important to monitor this ratio because a high LTV indicates higher risk. Lenders typically require an LTV of 80% or lower, meaning you must put down 20% or more as a down payment. Maintaining a healthy LTV ratio is crucial for managing risk and ensuring that you're not over-leveraged. If your property values decline and your LTV increases, it could make refinancing or selling the property more difficult. 4.5 Create multiple exit strategies. Leverage can be a powerful tool, but it's essential to have multiple exit strategies in case the market shifts or your financial situation changes. Some exit strategies include, sell the property. If property values have increased, you can sell the property and pay off the mortgage, keeping the remaining profits. Refinance the property. If your property has appreciated, you can refinance the mortgage to lower your interest rate, reduce your monthly payments, or pull out equity for future investments. Hold the property for long-term cash flow. If the property is generating positive cash flow, you can hold it for the long term, allowing the mortgage to be paid down while enjoying rental income. By having multiple exit strategies, you can protect yourself from unexpected market conditions and make more informed decisions. Part 5. Real-life example of using leverage to build wealth. Let's take a real-life example of using leverage to build wealth in real estate. Meet Jane, a real estate investor who started with a $100,000 down payment on a $500,000 rental property. She used a 30-year mortgage with a 4% interest rate, which allowed her to purchase the property with a $400,000 loan. Over the next 5 years, Jane rented out the property, generating enough rental income to cover her mortgage payments and other expenses. During this time, the property appreciated to $600,000. Jane then refinanced the property, pulling out $80,000 in equity, which she used to purchase a second property. By using leverage and refinancing, Jane was able to build a real estate portfolio with minimal upfront capital. Today, she owns multiple properties, generating passive income and growing her wealth through appreciation. Part 6. Conclusion. In conclusion, leverage is a powerful tool that allows real estate investors to control more assets, generate passive income, and build wealth faster than they could with cash purchases alone. However, it's essential to use leverage wisely, manage risk, and avoid over-leveraging. If you're considering using leverage to build your real estate portfolio, start by assessing your financial situation, choosing the right loans, and creating a solid plan for managing your investments. With the right strategy, leverage can help you achieve financial freedom and long-term wealth. Thanks for watching today's video. If you found this information helpful, please like the video, subscribe to Muscular Brain, Fat Wallet, and hit the notification bell for more real estate investing tips. Feel free to share your thoughts or questions in the comments below. How do you plan to use leverage to build wealth in real estate? Let's continue building wealth together.